Ladies and gentlemen, in today's show, I want to talk to you guys about Data Driven Investing's latest article. He talks about the federal interest rate cuts of 50 basis points that just recently happened and what the implications of SoFi or for SoFi stock is going forward. He breaks it down into each individual lending segment. So that's personal loans, student loans, and home loans, with large emphasis on that student and home loan variant, right? Because we've only seen SoFi in the last couple of years be in an environment with raising interest rates. We've seen this massive understanding of personal loans, and you can see how they sort of benefit. Where on the opposite side, we've seen a retraction from student loans and a retraction from home loans. So it's not been in full focus. I think the reason why I'm showing you guys this article is the fact of how well data-driven investing breaks down the implications for SoFi for student loans and home loans going forward. So over just right above my head here, you can see all the chapters that we're going to be covering here. Okay, so that'll be very interesting. You can read this article yourself at datadriveninvesting.com, but for now, we're reading it on Notion. All right, I've highlighted a few parts just to make us get through this article much faster. First off, the Fed has cut interest rates by 50 basis points. What does that mean for SoFi's business? We always talk about interest rates being cut. I think it's important to understand that it's not just about the total amount of rate cuts, it's how the rate cuts are done. So I think it's important that Chris highlights that rates coming down slowly also means that we're not in a recession and that we're in this Goldilocks area where every loan that SoFi ends up signing will end up being sold at very great gain on sale margins in the next rate cut. Okay? If the rate cuts are too large, it can be very bad for repayment terms and these sort of factors for SoFi as well. All right, starting with personal loans. A lot of personal loans are consolidations of worse debts like credit cards. The logic is that, some people think that personal loans might not be that great in the next interest rate environment, meaning a lowered environment. I believe that to some extent, but he's saying, with interest rates falling, it's still going to be a massive difference between, SoFi's personal loans, 13%, and credit cards at 22%. If the numbers come down by 3% or something like this, where even credit cards might be at 18% and SoFi's personal loans are at 10%, this is not going to happen on a 50 basis point cut, but I'm talking about in more extremes, that's still going to be a massive spread and enough for people to refinance their loans to SoFi. Now, SoFi's business model is still to originate and sell. Even though they freed up some extra capital with the converted note deal earlier this year, they'll still need to be prudent on how to best use their balance sheet going forward. See, I, being a little bit more growth focused, have always just wanted SoFi to be playing it very close to the legal requirements, especially now that they've freed up so much additional capital. I want them to fill that gap. But Chris is probably right here in saying that, SoFi still is probably going to keep some level of a buffer while we still try to figure out if there's a recession looming or something along these lines that might end up hurting SoFi more than they anticipate. Anyway, selling loans will continue to be a key source of revenue, and if they can't sell loans, it'll constrain how many personal loans that they can originate. One of the great reasons for interest rates coming down. In this environment from Q4 of 2021 all the way to Q3 of 2023, where, selling personal loans has just completely dropped off, this has been in the environment where interest rates had continued to climb. In the last 3 quarters, Q4 of 2023 to Q2 of 2024, there was a lot of understanding that there was not going to be another interest rate cut. That's very important. And now, obviously, in Q3, we did get the cut. So we'll probably see as high of personal loan selling or even potentially more, knowing that the pricing is going to be better. Like he says here, they're realizing better and better margins on their sales as time goes on as well. To highlight here, Chris does it as well, but they don't have every single point of data. It's not that Chris couldn't find it. It's that they don't disclose it in every quarter. It's in their actual calls that they say the gain on sale margins, and it's not always that they reference it. But it still gives you a good point of reference to say, hey, this has been going up pretty steadily, even mostly in an environment where interest rates were climbing. Now, when interest rates are completely cut, not just stagnant in these last couple of quarters, we may see an increased rate of gain on sale margin. And actually, I can almost guarantee that. But increased liquidity and increased demand for high yielding assets as rates come down should be a large tailwind for the business as a whole. Well said. Overall, the amount of loans that SoFi still originates is minuscule compared to the total amount of capital needed across banks and asset managers, meaning there's no cap. I mean, there is a cap, but not for SoFi. You're talking more against the JP Morgans and such of how much they can truly originate to sell, right? Whenever you're dealing at SoFi size, there is an unlimited amount of loans that we could give out. We couldn't grow fast enough. So, for at least for the time being, we will not have to worry about any potential cap in the amount of people that we're actually giving away loans to. The only thing that might stipulate that is the quality of loans that we give out to. It's much higher FICOs, and that would limit the pool once again if you're looking for 750 plus FICOs and 170,000 plus incomes. Chris does this thing. I don't follow this very closely, but you guys are welcome to, and I'll definitely cover it here because he is personal loan originations per member is something that he said, hey, if we can get this back above $500, that'll be a good place for SoFi. And considering this still like just sheer number of new members that SoFi is bringing on, if we can keep that above $500 per member, that is a great indicator that the lending segment is going to skyrocket. Huge tailwind for student loans, home loans, and HELOCs for the next segment here. So let me read this quote from Anthony Noto. We're being cautious today. If rates come down, this will open the gates for our student loan refinancing business and our home loan business, which is really small right now. Open the gates. And this is potentially even talking back then about a 25 basis point cut. Getting a 50 is probably even going to be much more influential in that decision to open up new lending lines. I mean, they've already done it, but in terms of the quality or the total quantity that SoFi does, it's not even close. Now, federal student loan interest rates are higher than they've been in 20 years. Origination volumes for student loans and all types of home loans will increase as rates come down. A slow and steady move down here will lead to a long and lasting tailwind as demand slowly increases and membership continues to grow. Remember, this entire time that we've continued to bring on new financial services members, whether it's through SoFi Money, SoFi Invest, SoFi Relay, all of these other products that had not brought in a lot of revenue, well, those are potential students. Those are potential home buyers. Those are potential cross sales, okay? They've just not been able to get into those products because, well, SoFi has not been able to offer a really compelling reason to switch. But now as rates come down, that completely flips on its head, right? And the moratorium is gone. So that's also very interesting. Now, some of the biggest players in the student loan space, like Discover and Common Bond, have both completely exited the space over the last several years. Okay? SoFi is one of the last remaining players. In fact, they are the largest player in this space, according to, well, it's not just data-driven investing. Even Chris Lapointe, the CFO of SoFi, has said they have about a 60% market share of the private student loan business. And I think that this market share will only grow over time. All right, student loans. Before SoFi received their bank charter in Q1 of 2022, they would sell all of their student loans within about 3 to 6 months of origination. Not because they wanted to always, but because that was actually mandated. All right? Something important to understand here. One of the reasons why they had completely stopped selling a lot of their loans is the fact that the gain on sale margin for a lot of those loans either went down so low that it was not worth it, or it actually potentially went negative for some of these loan products. So they just don't want to sell them. They'll hold them on their balance sheet. Here is their originations and loan sales. And then another one is their weighted average interest rate for each of their products. Student loans here, much, much lower interest rates than personal loans. But obviously that comes with some benefits as well. Let's talk about it. Annualized default rates. Personal loans, much, much higher, okay? And student loans, extremely low, less than 1%. So although you're making a lot less on the student loans, you're also not finding any defaults on those loans. However, the cost of funding for both sides of these loans are also equal, which is the cost of deposits, the cost of warehouse facilities, all of these things that actually data-driven investing will talk about later, and the implications for SoFi whenever it comes to interest rates as well. But anyway, we'll get to that in a second. Because student loans are so reliably paid back, they are very attractive to asset managers who require very stable, low risk, and higher yielding than treasury assets. Okay. Historically, SoFi has gotten a gain on sale margin of around 4% on their student loans, which is not much lower than their personal loan gain on sale margin because those cash flows are so reliable and people are willing to pay for them. Okay. So, interestingly enough, in Q1, this actually raised a little bit. Potentially, we may see in Q3 another increase. He gives a good example here. Chris does. Why would asset managers pay $104 for $100 of loans with such low interest rates? SoFi student loans can vary from 5 to 15-year terms. In other words, those who buy the loans will make their initial investment back in just over 1 year and then have very reliable profits for many years after that. I think that that's an important reason to understand this as well, is like the cost of buying these loans, in a one-time fee and then seeing it pay out over many, many years is such a great business for those asset managers. But it's also amazing for SoFi as well, because then we don't have to sort of take on that slow interest rate amount for SoFi to end up growing their business. They can just originate and sell those loans and then take all that money back and then go out and do it again. It's actually a much harder business to do that because they have to continuously find the leads. But if SoFi is this member attracting business, that's the part that they're going to be able to excel at. And it's actually a much faster business than holding it on their balance sheet. I think student loans will be a mostly capital light business. I think it's overlooked and will surprise many people going forward. It's certainly going to surprise me. For the most part, I've overlooked student loans because it has not been in the limelight, but that is going to change very quickly as rates start to come down, and it's going to come back as being one of SoFi's very, very strong products. Remember, they've been underwriting and originating student loans since the very first day of that company, right? That's how they started. So if there's anything that they're very good at doing, it's going to be the thing that they've done for 10 plus years. Anyway, home loans and HELOCs. Or home equity lines of credit for those. Anyway, SoFi's home loan business is capital light, and they cycle their book almost always within 3 months of origination. So as volumes go up with rates coming down, this will only be a tailwind to non-interest income, which would fall under the loan sales. Look at this. The blue bar is originations, green bar sale of loans. It's almost equivalent every single quarter. And in fact, every single time that it's lower sale of loans than originations, the next quarter follows with a much stronger amount of loans sold. The last quarter saw more originations than loans sold. Q3 might line up to be quite the book of loans sold for home loans as well as a much higher amount of originations because of that interest rate coming down. It'll be an interesting quarter. I'm telling you, this is lining up to be a very interesting quarter that we're going to have, and that's probably just going to be at the end of October that we're going to see those results. Anyway, we do have the capacity now of doing home equity loans as a principal. It's a secured product. We'd underwrite as much of that as we could, given it's secure, and we have very little secured lending on our balance sheet. Now, I was always worried that if you're going to be taking on some of these more home loans, like lower amounts of if they are secured, then they're much lower interest rates that you're going to end up seeing on those. But honestly, Chris sort of showed me this in a different light. I had no idea. He said, because it's secured, the risk weighting is only 50%, meaning that if a customer has a $100,000 HELOC, the risk weighted capital it takes is only $50,000. So what he means there is that because we have capital ratios, we can only have so much leverage in the business. We have to have a certain amount of cash in case there's a larger amount of defaults that happens in the total lending market, right? But because they're secured products, What he's saying is for this specific product, you have to hold about half of that versus what you would need to hold if it was a personal loan. So we could write $100,000 worth of HELOCs where we could only write $50,000 worth of personal loans. And yet the rates, this is what Chris is seeing on a $100,000 HELOC. Chris is at a FICO score of 815. Okay. So whether he's looking at a 30-year rate or a 20-year rate, you're looking at between 8.75 to 9.375% on an APR basis. Double that up. That is so much more valuable than the personal loans. Of course, they would originate it, and it's a secured product. Very interesting. Anyway, getting rates for HELOCs was super easy, and it took about 3 clicks through SoFi, Chris said. Okay. He is already a member, so they have all the information. But also, it's something like 70% of all home loans that they end up writing are cross sales in-house. That's also very important. So this is the experience for most home loans that SoFi is dealing with, and that's only going to grow as they continue to grow their member base through financial services. All right. Lastly, cost of capital. So SoFi has already lowered the rate from 4.6 to 4.5%. Not much, but that's still, as the rates come down, this will end up lowering their cost of capital. They use those deposits to fund the loans. So if they just brought it down by a tenth of or 10 basis points, essentially, that is actually going to lower their cost of capital. If they decide to keep it higher, that's fine. But their variable rates on their warehouse facilities will come down. So their average cost of capital will come down, and we're already seeing that over the last 2 quarters. In the last quarter, we also saw them draw down their time deposits or their CDs. So this is also another aspect is just, since we've had the banking license, we've been talking about what they've been doing with their loans. And we've talked about all the financial services products, but all along, they're also making a much better structure for their cost of capital. And now we're at that point where it's looking very juicy. And lastly, let's read this out from Chris. Rate cuts unlock liquidity for banks and asset managers to purchase SoFi assets. They spur demand for loans as the cost of those loans decrease. They especially increase demand for student loans and home loans, and much of the increases in their lending revenue will be generated in capital light ways through loan sales. Moreover, existing loans on their book will generate greater net interest as the funding costs come down as well. I think over the next 12 to 18 months are going to be transformative for SoFi and the company and SoFi, the stock. Who knows about that SoFi stock? I mean, it will do whatever it wants. But the idea is that the company itself is growing dramatically. So if you do want to be a long-term investor, this is exactly the company that a lot of people will look forward to, right? A company that is growing over the very long term, potentially even finding compounded annual growth rates of roughly around 30%, okay? They're bettering their expenses. They're getting stronger over time. They're getting more members, which is great indicator for growth, but yet it's completely unloved by the market. It feels painful right now, but over the long term, everything I'm reading and everything I'm seeing from SoFi is making me a very happy investor. Ladies and gentlemen, thank you all so much for watching. Please give some love to data-driven investing, but until next time, bye for now.